For 5 decades, a single mathematical formula governed the way we built wealth. It was treated as the undisputed baseline. But that formula has quietly broken. The strategy was simple: keep 60% of your money in growth equities and park the remaining 40% in safe bonds. Whenever the stock market took a hit, those reliable bonds acted as a mathematical shock absorber. That mechanism worked flawlessly until the structure of the macroeconomy shifted. Driven by fractured global supply chains and rolling energy shocks, we have entered a distinctly different economic environment. The sudden spike in consumer prices we saw post-pandemic isn't reverting to the old baseline. We are now dealing with a reality where a higher, more volatile level of inflation is structurally baked into the system. This persistent inflation has dismantled the ultimate financial safety net, leaving passive investors exposed to systemic erosion. When inflation runs hot, central banks have one primary reflex: they hike interest rates to pull money out of the system and cool the economy. As those new, higher interest rates hit the market, the fixed-rate bonds you already own become less attractive, driving their market value down at the same time corporate profits and equities take a hit. This creates a correlation spike. The exact mechanism designed to protect your portfolio fails. Your safety cushion drops in lockstep with your risky assets. The natural instinct is to flee to cash to stop the bleeding. But with inflation running near 3%, holding cash guarantees a silent, compounding loss of actual purchasing power over time. The synchronized collapse of stocks and bonds indicates that the foundational math of the 60-40 split has structurally broken. Surviving this regime requires a shift in how we measure success. Generating a nominal return is now insufficient. The primary objective is a real return, a yield that actively outpaces the rate of inflation. If traditional bonds cannot provide that cover, we must evaluate asset classes based on two traits: how volatile they are and how they correlate to rising consumer prices. This scatterplot maps the modern investment landscape. To replace traditional bonds, we need assets that limit stock correlation but maintain positive inflation correlation. Looking at the lower left quadrant, cash and government bonds sit in the danger zone. Protecting your wealth requires migrating capital out of those left quadrant traps and engineering a portfolio with assets that actually respond to rising prices. The first step is anchoring a portion of your portfolio in the physical world. Real assets and commodities function as direct hedges. The economic logic is straightforward. Commodities are the input prices of the global economy. As the cost of living goes up, the raw materials required to sustain it naturally rise in value. Precious metals play a similar role. Physical gold has historically acted as a reliable diversifier, particularly when geopolitical tensions fracture supply chains and deficits expand. Beyond raw materials, global real estate and private infrastructure provide defense through built-in rent escalators. As materials get more expensive, these properties actively reprice upwards. When paper assets and fiat currencies slowly burn off their purchasing power, wealth has to be tethered to tangible assets to hold its ground. The next step in diversification moves beyond public stock markets. Active alternative strategies like diversified macro and relative value hedge funds are engineered specifically to detach from standard market crashes. They do not rely on the broader market going up to generate a return. Returning to the data map, we can track these diversified hedge funds to the lower right quadrant. They offer the lower volatility we need while proving a positive correlation to inflation. Finally, we address the fixed income core. You do not abandon government bonds. You replace them with variants that are structurally linked to inflation. Treasury inflation-protected securities, or TIPS, provide a direct mechanical replacement for traditional bonds. Their principal value adjusts upward in lockstep with the consumer price index. The modern portfolio functions as a custom-engineered machine, blending tangible assets, active alternatives, and inflation-linked securities. The biggest hurdle to this transition is psychological. It is deeply uncomfortable to abandon the models that worked so well for decades. For retirees, the instinct is often to retreat to cash and bonds for perceived safety. But math dictates the opposite. Maintaining meaningful equity exposure throughout retirement is historically one of the only ways to outpace inflation. Aggressively reallocating a portfolio comes with short-term discomfort, but that friction is nothing compared to the invisible, compounding devastation of letting inflation slowly bleed away a lifetime of savings. The set-it-and-forget-it strategy of passive wealth building cannot sustain its value in this regime, Survival requires constant, active adaptation to changing market gears. Ignoring inflation's compounding effect creates a risk that emerges slowly but proves devastating once the math finally catches up.